Have you ever seen price just shoot off and leave an imbalance behind? That's what smart money traders call an FVG, and today I'll break it down step by step. Welcome to Merge FX Trading Hub, where I simplify Forex and smart money concepts so you can grow your account with confidence. If you're here, hit the subscribe button so you don't miss any of my weekly trading breakdown. Now, let's start with what FVG is all about, right? An FVG is a price imbalance created when the market moves too quickly, leaving unfilled orders between three consecutive candles. All right, so as you can see on your screen right here, we have three consecutive candles. And how do you identify an FVG? First of all, what you need to identify is three consecutive candles of same colors, right? Of same colors. So how do you identify fair value gap? Right now, you first of all need to see that candle one closes low, all right, and candle two shoots up, and candle three doesn't retrace enough. Right now, the gap right here is known as the fair value gap. I said firstly, if candle one closes low, candle two shoots up, and candle three doesn't retrace enough, the gap between candle one and candle three is the fair value gap. And why this matters is because the market often come back to fill the imbalance. The fair value gap is an imbalance, and like I said, it matters because price tends to fill the imbalance before it continues to the upside. Now, mind you, this is a bullish fair value gap, right? That is the bullish fair value gap. Now let's look at what a bearish fair value gap looks like. Now we can see where we identify three consecutive candles right towards the downside. Now this is for downtrend. Okay. Now you can see that the first candle closed high and the second candle pushed lower, while the third candle did not retrace enough to overlap the first candle wick. All right, now how do we identify the fair value gap right here? To identify the fair value gap right here, we said the gap between the first candle and the third candle is your fair value gap, right? That means we have this area as a fair value gap. So guys, the daily fair value gap often appears in a downtrend, and price is likely to revisit the gap before continuing lower, just as you can see right here on the diagram. And the bullish fair value gap appears in an uptrend, and price is likely to revisit the gap before continuing, to the upside or before moving higher. Right now, one thing you need to ask yourself is which of these fair value gap is valid, either in an uptrend or a downtrend. Now remember, we have higher time frames and lower time frame fair value gaps. Now you need to ask yourself which one holds more weight. Is it that of the higher time frame or that of the lower time frame? I believe you've answered that. Now higher time frame gaps hold stronger than lower time frame fair value gaps. Now moving on, how to trade fair value gap. Now these are the three or the few things I look out for to trade using the fair value gap. All right, now I'll have to wait for price to come back into the gap. Okay, now if price gets back into the gap, you can as well as use confluences like structure, okay, to identify your higher highs and your lows, right? Then liquidity zones and other SMT2s like the OBs, which is the order block. If you want me to drop a video or talk about liquidity zones and order block, hit on the like button and drop a comment, so I could consider doing a video regarding liquidity zones and order blocks and how I trade using liquidity, order blocks, and fair value gap. Right now, your entry will be when price gets into the fair value gap. All right, when price gets into the fair value gap, right about this point, and price gets into the fair value gap, So Excel is usually below the fair value gap if it is a bullish fair value gap, or above the fair value gap zone if it is for the bearish fair value gap, while your take profit will be at the next liquidity pool or opposing, imbalance, guys. Right? These are the common mistakes that most newbies, do while trading with fair value gap. They enter without confirmation and they trade every fair value gap they see. Now, not every fair value gap you see are valid, and I'm going to make a video regarding valid fair value gaps, and they also ignore higher time frame context. All right. So guys, this is an example of a trade, a scalping strategy trade. I use FVG, a couple with order block to take. Now looking at this now, remember we said we look out for three consecutive candles, and right here we can figure out candle one, candle two, and candle three right here. And we can obviously see that price created an imbalance, which we earlier said that it is which you earlier said that it is the fair value gap, right? Now, coupled with the liquidity pools, I'm going to make a video regarding liquidity pools, but for fair value gap, you can see how price came into the fair value gap right here and then pushed to the upside to create another move to the upside, right? This is an example of a bullish fair value gap. Now, I told you guys that I'm going to drop a video regarding how I trade using fair value gap, liquidity pools, and other SMT tools. Okay, like the order block. I'll see you guys in the next video. Peace out, guys.